Hi, and welcome to Two CPAs The Mic, the podcast where we talk tax, finance, and all things related to business. Whether you're a business owner, working professional, or someone who wants to start a career in accounting, this is the podcast for you. Hosted by CCK Strategies partners Jeff Frable and Sara, we dive into relevant business and tax matters with working professionals to make these topics less intimidating, relatable, and dare we say fun? Let's get down to business.
Welcome to this week's episode of Two CPAs The Mic. As always, I am Jeff Frable with CCK Strategies, and we are so glad you joined us today. We are covering relevant business and tax topics, but doing it with applicable, straight talk, practical information, and not all the jargon and stuffiness that generally goes with our profession. With us today, again, my wonderful co-host, Sara Mays. What's up, Mays?
What's up, Frable? I'm here, but today's a little bit different.
You know, I think we should get a badge for what we're doing today.
Yes.
And explain why we should get a badge today.
Well, we are taking a break from the rigor of our April 15th deadline and recording this podcast for you guys because, number one, we think it's important. Number two, Frable, you and I need a brain break.
So today is April 6th.
Yes.
Let's just be transparent with our listeners. Today's April 6th. Today's probably the worst week of the year. Not the year, but for like the first 6 months of the year. This is the worst week of the year. We're trying to get these extensions done. We're trying to get these returns done. And like you said, we're getting pelted from every side.
Yes.
And we actually are doing this because we want to take a break today.
We want to take a break. But let me just say this. I think Frable, we have to tell our listeners, we kind of secretly love it.
We kind of secretly, yeah. I mean, it's not secret because my wife knows that. Yeah. And
we may get a little bit grumpy, but deep down, we're just like, it's fun.
The one thing we do need to make extra clear is while we are maybe complaining a little bit, we are not that busy that we can't take new clients and all that kind of stuff. It's just that right now there's just there's a lot going on, and we keep looking for that getting over that hump.
Yes.
And that will probably come on Wednesday or Thursday of this
Wednesday
week,
or Thursday,
which is a full week in advance because we have an amazing tax division leader.
Yes, and a whole team.
A whole team. And so again, we joke about that, but we are here to help our listeners. We're hoping this drops the day after the 4/15 due date. And that's why we really wanted to do this episode, because we want to go through the concept of where are you at after you get past that initial tax deadline.
Yes, that's
right. In other words, are you still struggling? Because we had an episode last year where we talked about planning and why that's important. And now we thought, well, let's get one in the can and we'll release it the day after the extension where we can talk about how you might be feeling as an entrepreneur after the 4/15 deadline and things to be thinking about.
Exactly. And also, too, just to know, even if you felt the crunch and you did file by April 15th, that you can still listen to our podcast and there's still room to make changes.
Your return may not be right.
Yes, exactly. Exactly. So there's never a wrong time to look at your taxes, even if you've already filed.
Yeah. And the other part about that is we do a lot of different episodes where we're talking with entrepreneurs and talking about their journey.
Yes.
And we do get into some technical things, but we don't get into tax specifically that much. And so this is an opportunity like we did with the One Big Beautiful Bill Act and with year-end planning that we can talk about some of these things. And so if you are an entrepreneur that's lacing up your shoes to go on a walk or a run, you definitely want to stay around because we're going to be talking about the things that your CPA, your tax provider should be talking to you about, using language that they should be using.
Yep.
If you are in a good spot, everything we're talking about will not surprise you. But if there's things that we surprise you with, then you might want to be thinking about how you change going forward. And so strangely enough, though, Sara, we don't have someone on the mic today. It's just us.
It's just us. Christy decided to not be here today.
Well, she was doing, her kids had an extended Easter break and she's been up since 3. And so she's taking a break. And besides, we were like, well, Sara and I can just talk to each other and it'll all be good. But even though we're talking to each other, it's going to be fun.
Yes,
it's going to be, we're going to have the information that you need. And let me give everybody just an idea of where this information comes from and how it germinated. So last week, I agreed to do a tax presentation for a networking group.
Right.
And so, first of all, I think I say this all the time. I don't know if I say it on this podcast, but I think we just need to get removed from our dialogue. I asked ChatGPT this because we all do it.
Right.
And so we know where it came from.
Right.
Pretty much.
Right.
But in order to kind of make this quicker, I did go to ChatGPT and I said, hey, I'm covering important tax topics that entrepreneurs need to be aware of. But even more importantly, I want an acronym that could be used for my 5 points, because it was like the top 5. And I want 5 good points. And I want it to be an acronym related to the nature of this networking group. Well, this networking group just happened to be having a chili cook-off when I went for that night's meeting, and I was the special speaker. Believe it or not, special. Believe it or not, the acronym that I got from ChatGPT was
chili.
And I was like, man, where has this been my whole life? I mean, ChatGPT is so awesome. I know it's killing the environment and all that kind of stuff, but
and it's not always accurate.
It's not,
but it's good for yes, it's good for outlines and emails.
It is,
and the
but
like.
I thought it was so amazing that it came up with this chili acronym. And so we're going to use it today. We're going to have some fun with it, and I hope our listeners are able to take that acronym and apply it going forward. So keep in mind that I'm going to do a spoiler alert here and give the 5 points so that you understand how it relates to chili, because it is not 5 specific tax ideas that go to chili.
That's right.
It's concepts. So with C, we're going to talk about choosing the right entity.
Mm-hmm.
With H, we're going to talk about harnessing deductions. With I, we're going to talk about investing intentionally. With L, it'll be leverage your time and resources. And I will be to integrate a proactive team and get all the right cooks in the kitchen. So again, this is stuff that if you're an entrepreneur and you're struggling from a tax perspective, whether you don't feel like you're being proactive enough or you are paying too much tax, or again, you cannot get a return phone call from your CPA, these are concepts that will be beneficial to know and understand going forward, and really kind of understand, shameless plug here, how we as a firm work with our clients through the tax planning and strategy process. So some of this stuff we've covered in past, and we're not going to go into a ton of details, but we do want to cover it. So let's start. I think we've covered everything, right?
Yes, we covered
you did Christy, we covered the chili, and,
yes.
and unfortunately, we're not eating chili today. That would be really cool. But
right, no.
And
we're
it's
back. kind of chilly weather today.
Yeah, it was over the weekend a little bit. I was going to say we're back in the studio again today.
Yes, our favorite place.
I love being in the studio because the quality of the sound is so much better than Teams.
It is. And so Robert heard a clip from our last episode, and he was like, Sarah, can you tell the difference? It is night and day. And
absolutely.
I was like,
So if you are one of our listeners and you're like, I can really hear this difference. We can hear it too.
Yes.
And we, it's a continual work in process. We have an amazing teammate, Clarence Fisher, that helps us through these things.
Yes.
And I think we mentioned in the last episode that we've got our podcast studio opened up and established. And so we're really excited about that, but that's where we are today. So,
yes.
All right, let's go. Choose the C in chili, choose the right entity. This is really the foundation of all tax strategy. You want to make sure you are structured the correct way. We had an episode where we went into a whole lot more detail about that last season. But Sarah, just kind of cover at a high level, what are we talking about here when we talk about choosing the right entity?
Well, first of all, what is an entity? So an entity is a legal structure on how you have your activity. What if all of your income coming in, all of your expenses going out, and really it kind of is the housing of what you do. And so there's different kinds of entities.
And what would they be from? Let's say from the least amount of legal liability to
the most
in theory. And
Okay.
you're not an attorney.
No, I'm not. Yes. Disclaimer, 100%. So there's a sole proprietor. You've also probably heard of sole prop. That is, there's no legal entity in that at all. And you're just operating under your name. And then there is a limited liability company. And there's actually two different ways to be taxed in a limited liability company. You can be taxed as a partnership, which is really a flow-through entity, or the LLC can be taxed as a corporation. And that corporation has its own tax structure or tax strategy there. And then also an LLC can make an election to be an S corporation, which is also a flow-through entity, but has different tax legalities separate from a partnership or even a C corp. And then you can be an incorporation, and the incorporation can be taxed either as an S corp or have it just its own C corp.
So lots of choices there.
So many choices.
And
then you have, so on Frable's outline for his chili, you have joint venture. We have never even talked about that.
No. So
there's a joint venture.
And there's a joint venture. Ask your CPA about that.
Yes.
I guess the key to all this is, well, let me ask you this question, Sara. This is all a cookie cutter approach when you want to structure, right? One size fits all, right?
Absolutely not.
Right. So there's differences, there's advantages and disadvantages for each of those as it relates to liability protection, which you want to talk to your attorney about. Tax rates, you mentioned pass-through, which is you end up paying tax at the individual level versus an entity that actually pays its own tax. Again, there's different tax rates. And there's also ways to basically, I would say, reduce certain tax burdens with the structure that you take. So,
because there is different taxes. When people say, oh, I got to pay my tax, that's, you mostly are thinking about the marginal ordinary rates for an individual, right? You know, where you hear about the stair step of I'm in the 24% bracket or I'm in the top 37% bracket. There's also other taxes to consider, not just ordinary income tax rates.
So we had a guest, one of our partners, Caleb Caldwell, last year, and he talked about NIL. And I had the privilege of going to see a presentation he did on the campus of Tulsa University last week. And he went into detail with these student athletes about the Social Security tax.
Oh, yep.
And how if you're employed, you only pay half or you get withheld half. And if you are on your own, if you are self-employed, you pay the whole thing, which is an additional 15.3% up to a certain amount. And then it's 3%. Yeah.
Well, and I think a lot of people don't, when they're an employee, they really don't see it.
They don't
just
even
see it on
know
their,
about it.
Yeah, they just see it on their paycheck and they're like, oh, okay. And it just is a huge surprise when people are.
It's a huge surprise, and it's somewhat of a hidden tax. We get into situations all the time. Someone comes in with a sole proprietorship, and you say, "Well, here's the ordinary tax on this, but you also have to pay $20,000 in Social Security tax." And they go, "What?"
Right.
They don't understand it. So again, it's very important to get with your tax provider, with your CPA, and have these discussions. There's various considerations to take into. Or various things to take into consideration, like the number of members or partners you have, how involved they are, how much revenue, how much net income, how are your members getting paid, those kind of things that all can have a direct impact on the entity that you select. So what you need to hear from us is make sure that if you need an entity, that you are properly structured and that you got one, and it can make a big difference for your. Let's go back to the example we're talking about. If at 415 you came up with a surprise on your extension or actual tax return, this may have a bearing on that number and is always worth looking at and reassessing.
Absolutely.
Okay.
Absolutely.
H, we're going to harness some deductions. And this is really where we get more into some of the strategy of deductions. I call it the place of constant creativity.
Yeah.
I don't know about you, Sara, but when I talk to my clients, I want them to throw everything in the kitchen sink at me.
Yeah.
I want them to tell me everything they think has a business purpose and give me and our teammates, us, the opportunity to say yes, or here's my concerns. Because if I don't know about it, if the client makes a decision that they think it's not deductible, I may not even know about it.
Right.
And so
I'd rather argue with you of why it's not deductible.
that's exactly.
Yes.
That's the CCK way, why
Yes.
it's not deductible versus trying to find the things that are deductible. And so there's a lot of things that go into consideration here about obviously everything that we're going to talk about for the next couple minutes must have a business purpose to start off with. Now, there's various things out there where the business purpose may be 50%, maybe 75%, but
Right.
you at least get some kind of percentage of that deduction. So,
And for an example for that, and I think that's where you're kind of going, but I think an example is if you're going to a conference and you tack on a vacation at the end of it, that conference and the travel around to and from is still deductible.
absolutely.
Is that where you're going?
That's one of my favorite examples.
Yes.
is someone goes, well, I went to Disney World with the family and then I stayed for a conference, so none of that's deductible. And we will say, no, you went to a conference and then you decided to tack on the vacation at the end. There are certain things that are deductible 100% because you had to get there for the conference.
Right.
Now, again, hear me. And whenever I give these presentations, I always tell people to raise their right hand and say, I promise not to take this back to my CPA and say those wonderful podcast hosts told me I could do this. Everything we're talking about must be run through a specific situation
Yes.
that you are in. But in this situation, we may say, well, no, you had to get there for the conference. So your travel is deductible.
That's right.
Now your family is not.
Right.
But your lodging for a portion may be deductible. Your meals for a portion may be deductible.
Right.
But again, if you think that there's no chance, we have no way to even consider that.
Yeah,
So,
don't just call it a vacation. Think about all the aspects of it.
absolutely. So let's run through some of the big things that are going on. I know, again, we talked about a lot of these with the One Big Beautiful Bill Act, but let's talk about some of these real quickly, kind of rapid fire them back and forth a little bit here. I'll start with bonus depreciation in Section 179 with the One Big Beautiful Bill Act. Let me just back up a minute and say, when we did that episode, we were trying to be very timely with the information that we were presenting.
Yeah.
Now we're 6 months, 7, 8 months more into it. And we've been seeing these on tax returns. So we know a lot more and we're much more in depth. But with the bonus depreciation, the thing that happened there is we're allowed now to take 100% bonus depreciation, which means you can write off fixed assets with more than 1 year life. You can do that if they have less than about a 15-year estimated useful life.
Yep.
And that was going to be 40%. It had been declining over the years,
Yes.
but the One Big Beautiful Bill Act made it permanent at 100%.
After.
There's always something.
Yes.
So don't take this black and white because there's always something to it. But after, what is it, January 19th, if the asset was placed in service after January 19th of 2025, you get 100% bonus depreciation, which means you get a full deduction for it. There's the 179 deduction is still out there, which gives you another way to write off a full asset. So sometimes it's a combination of the two. Again, one size never fits all. There's always an opportunity to do something with things of this nature. So be aware of that bonus depreciation. The qualified business income deduction, Sarah, QBID.
Yes, QBID.
Not QBIRT.
Right, QBID. That is the 20%. I'm going to say it like this, 20% flat deduction on any pass-through income. What I mean by pass-through income, what we were talking about earlier, is any income from a sole proprietor or a limited liability company taxed as a partnership or any S Corp. There is a 20%. There are limitations with that,
Absolutely.
As always. But for the most part, it is a flat, just kind of an extra, hey, incentivize that you are an entrepreneur and that you get an extra 20%.
So
off of the income. It is a deduction off of the income.
So practically speaking, you have a K1, which reports your flow-through income of $100,000. Generally speaking, that means you have a $20,000 deduction on your tax return. What this does, big picture, is it has the potential to move the highest ordinary tax rate from 37% down to about 30%. Now, one thing that's really interesting about this, Sarah, and something we always look at is I was talking to a new prospective client, and they have a thing called a specified service, trade, or business.
Right.
SSTB.
There's always an acronym for everything.
I'm not going to say it, but it's a system. And the issue there is if you're over a certain amount of income and you are in certain industries like, and really professional industries like an accountant, legal, and some other things, health. In this situation, it was health related. So if you're like a physician, if you're a doctor, you don't get this deduction if you're over a certain threshold of income. This prospective client, the tax return was marked STB income, which means they did not get the deduction. And when we looked at it, we said, no, you are not STB, which means you do get the deduction.
Right.
So if you think there's an opportunity to argue away or
even a portion of your activity.
Absolutely.
Yes.
So it's a big deal. And make sure if you don't know what QBID is, you should ask your tax preparer why it's not reported on your tax return. Yep. And again, it goes back to the flow-through income, the pass-through income. The next item is vehicles. Just always be aware that vehicles can be used for a business purpose. And when you put that vehicle in service that first year, you make a decision to take actual expenses, which would be your gas, insurance, everything it takes to operate that vehicle.
And the cost of the car.
And the cost, including depreciation. Or you take the mileage approach, which means you basically just take your number of miles times a rate, which now is about 60 to 65 cents.
I think it's 70.
Is it 70 now?
It's jacking up.
It's jacking up. So you get that deduction. The nice thing there, and one of the biggest differences, is if you take actual and depreciate your vehicle, if you sell it or take it out of the business, there will be tax ramifications. Right. If you just take mileage, you do not have those similar tax ramifications. So it goes back to what is the best situation for you. Home office, Sarah.
Yes, home office. So especially in our post-COVID world, a lot of people are still working remote, meaning they are working from their home. And you can take deductions around the office where you actually conduct your business in your office at your home. You can take those deductions. So there's a myriad of different ways
considerations
and how to calculate this.
Ask the question. Yes. I work from home. Do I have... Now, this doesn't mean...
A W-2 employee, right. Is that where you were going with that?
Well, W-2 can't take it.
That's right.
That's right. And where I was going is this doesn't mean you can write off your whole home. It doesn't work that way. There's criteria to meet. And just it goes back to being aware that there could be an opportunity there. So have the discussion.
Yes, absolutely.
And now while we're talking about homes, there is the concept of a second home. And the reason we throw that out there is just be aware that with certain things like your itemized deductions, there are available deductions for that second home. So a vacation home, there's the opportunity for mortgage interest, property taxes. But again, there are limitations. There are issues to consider. Second home could be what, Sarah?
Also your office.
No, it's on the water.
The boat.
Oh,
Your boat.
Your boat.
I was going to say, well, then if you're going to go there, then a camper too.
Well, it has to have what to qualify as a second home? A potty.
Oh, I did not know that. I just learned something new, people.
It's got to have a commode.
I didn't realize it.
Yeah, that's why the boat qualifies. Is if you have a commode on your boat, then
your RV has to have a commode too.
Your RV would have to have a commode too. Okay. So again, if you have some mortgage interest or property taxes associated with these things,
can you strap a porta potty to it?
Now you sound like my clients. So I wanted to do that's my boat. I love that quote from
Jenny. Yeah, Jenny.
So anyway, again, be aware. And the third thing that I'll throw out there, we're going to go there right now.
Okay.
With the Augusta rule.
Oh, yes.
We got to be careful with this because I think this has a lot of potential for being misused and being abused. And at a very high level, there is a tax code section that allows you to receive 14 days of rental income
for free
and not pay tax on it.
Yes, that's right.
And you go back to why is it called Augusta? What does it mean? It goes back to Augusta, Georgia, which is where
the Masters
is. And if you've ever lived in a city that hosts a major sporting event, you will know that there's participants that come in, and people will leave town so that they can rent out their home.
Right.
And this was going on in Augusta, Georgia. The tax code was changed so that that income or that those funds received for 14 days does not get reported as income.
Right.
And so there are opportunities out there to, if you have a related business,
yes,
there are ways for you to rent from your business and not recognize that income, which means you take a deduction on the entity, it reduces your income, and then you don't have to pick up the income on your personal side.
Mm-hmm.
Usually it's a wash. You take a deduction on one side, you pick up the income on the other, and it washes. But this, you take a deduction and you don't pick up the income. And here's my concern on this, really. I mean, this is all over TikTok. I'm not on TikTok, but this is what I hear. I probably talked to 10 different clients at the beginning of tax season that bring this up. And yes, it is out there.
Yep.
Yes, there is some fairly strict criteria that I would adhere to in order to defend your position. Someone said this, I can't remember who said this to me before, but they said, and I think it was Ox, because I was talking to Ox. Ox said, you will probably not get audited because of this, but if you do get audited and it's examined, they will look at this.
Yes.
And so that's not to say you won't get audited about it. So abuse it and take the audit risk.
Yeah.
It's do what you need to do and do it right and do it in a way that is documented.
Absolutely. And probably the biggest, I mean, there's a slew of things that you need to consider, but you can't, on the abuse side, you really need to watch your fair market value on the rental. And you just really have to look at a whole lot of things. So tax advisor.
Going back, pigs get fat, hogs get slaughtered. And I think really my concern is whenever we as professionals hear our clients bringing something up over and over again, it's causing attention. I really think the IRS is going to pick up on this and they're going to do something about it, because it's just, I think there's a lot of area for abuse here.
Agreed.
And so just, again, going back to the concept, it's not cookie cutter. It doesn't fit all. You need to document. You need to have a defendable position with what you do.
Yep.
Okay. Meals and entertainment. Sarah.
Oh, yeah. So meals, and actually there's some even rule changing for 2025, or it's either 2025 or 2026. But for the meals and entertainment, historically have been limited to 50%. So if you spend $100 on a meal, a business meal, you would only get to deduct $50 of that. So that's where that 50% limitation comes in. For a while in the COVID and a couple years after, just to help with the economy, meals were 100% deductible. And then now we've gone back to the 50% limitation, but now they've also added in any entertainment is 100% not deductible. So, and when we're talking about entertainment, we're talking about, even taking a client to a golf course or taking a client to a concert or anything.
Tickets.
Yeah, anything
Things
like that. That is now not deductible. But they've also started looking, there's a little bit more limitations for businesses to that if they provide meals on premise, that's not deductible at all. Like the Facebooks of the world that have a cafeteria on site, all that food for cafeteria is not deductible.
There was, going back to the COVID era, there were situations that allowed for 100% deduction of meals. Usually it was if you were providing meals for your employees to basically keep them there and things of that nature. And they've kind of cut down on that a little bit recently. There are still opportunities for 100% deduction on meals. Generally, what I would say at a very high level is like a summer company picnic.
Yeah.
The traditional Christmas company dinner, those kind of things do tend to be 100% deductible, but that has been limited in the past year. And then, like you said, you used to get that 50% deduction for entertainment, but that's been down to zero. So anything, that doesn't mean that, let's say you do take your client to the World Cup.
Yeah.
The more than likely, again, nothing is ever black and white, but more than likely those tickets are not deductible.
Right.
But if you buy your client some popcorn at the event, that would be
Yes.
deductible.
Right.
If you take your client to dinner beforehand and you have a business purpose for that dinner, there could be that 50% deduction there. But just make sure you understand that entertainment is no longer deductible.
Right. And also just to point out too, like if you're buying a package that includes tickets and meals and all those things, don't just give it at face value at, oh, I spent $1,000 on this, so it's all not deductible. Absolutely not. Keep that invoice and we can
break it down.
Mm-hmm.
Break it down. Absolutely. Okay. What we go back to saying the no tax on those changes in the most recent bill. No tax on tips. So if you have tips up to 20, again, this is all subject to income thresholds, generally $150,000 if you're single or $300,000 if you're married filing joint. There's no tax on tips, the first $25,000 of tips. Now, if you and I were married and we both worked in that industry and we both had, that applies to each of us.
That's right.
We could get up to 50. There's no tax on overtime, meaning up to $12,500 per person. So if you're working overtime, that first $12,500 is not taxable. And the neat thing about this is that you don't have to itemize to get this deduction. It's in like an other activity type of form, and you report this there, and you don't have to itemize to take these deductions.
But your employer should give you a breakout of if you had tips and overtime. Actually, my daughter had on her W-2, she had some overtime and it was broken out for her. So if you know you have tips and if you know you have overtime and you don't have that breakout, be sure to ask your employer for that.
I would say if you have tips and overtime, you probably will, it's very likely you may have this reduction, not really a deduction, but a reduction of income.
Mm-hmm.
And also keep in mind, this is 2025 through 2028. So this is one of the things in the One Big Beautiful Bill Act that was not made permanent. It's got a 3-year lifespan to it. The other things that changed or that were added is that we now can get a deduction or a reduction in income. Oh, no, it would be a deduction for the auto interest. Mm-hmm. So if you have a car that was a vehicle that was purchased after, I don't know the exact date.
It's sometime in 25.
It may be January 1. I'm not exactly sure, but let's say it's 2025. You buy a vehicle, it was assembled in the United States, and you have a loan on it.
Mm-hmm.
You now have the availability to take a deduction for that interest. That's never been there as long as outside of a potential business expense. But does not have to be business.
No.
It can be absolutely personal.
Personal, yes. Actually, I think most loan providers are actually sending out year-end letters because you have to report your vehicle identification number on the tax return.
Okay.
Yes.
And I think there are some income limits out there too as well.
Mm-hmm.
So again, if you bought a car in 2025 and you had a loan on it, make sure that you're taking that deduction, and it doesn't have to be business related. And then finally, the charitable contributions. This goes back several years ago where each individual was allowed up to like about a $300 or $500 charitable contribution deduction, even though they didn't itemize as long as they made the contributions. Same thing that's gone into effect here in 2025, only the numbers are a little bit bigger. So be aware that if you are making charitable contributions and you cannot itemize, there is a provision to take some of those deductions in the current year. All right. Those are kind of the biggies. And Sara, this all goes back to making sure that you're paying the right amount of tax. It sounds so silly. It sounds so elementary to say that, but there's just various things to consider. Run through those real quick. What are the top 4 or 5 taxes out there?
There is your just an ordinary tax rates, which are those tax brackets that you hear. There's capital gain rates, so that if you have a capital gain or you're paying qualified dividends, there's a lower tax rate that's 15%. There's that self-employment tax that we talked about earlier. That's about 15.3% on your self-employed income. There's the net investment income tax, what you hear people call NII. So if you're over a certain threshold of income and you have interest, dividend, capital gains, or even annuities, that has a special 3.8% tacked onto that. And then There's also, if you have any rental,
just making sure that
that
you're
you have that you're avid. Yes.
that you're assessing the Social Security tax.
Yes. And then if you're actively involved in a business or not actively involved in a business, there's limitations on any losses that you have, and whether you can take it.
Right. It all boils down to you want to pay the right amount of tax, you want to be strategic and proactive, but you also want to maintain your documentation because you need to be able to prove these things if there's ever a problem. Okay. That was
audit,
the A word. All right. That was H, harnessing your deductions. We're probably going to hit these last ones pretty quickly, but investing intentionally, really what we're getting there is making sure that you are investing in yourself in areas that can reduce your tax liability. Mm-hmm. So like with retirement savings, whether it's IRAs or 401ks, make sure you're in the right vehicle first, because sometimes, if I got a younger person, I'm probably going to go, do you want a Roth? You don't get a deduction for that, but it all grows tax-free.
That's
so
right.
Make sure you're putting money, the excess funds that you have in the right spot to get the best tax result possible. So again, those would be retirement options. They would be things like FSAs and HSAs, flexible spending accounts, health savings accounts. One thing that we've been talking about a lot recently internally that is really kind of a neat deal is there really isn't, I don't think there's a limit on on the HSAs, the health savings accounts. You can put the money in there. It doesn't have necessarily a contribution threshold or limitation like some of your 401ks do and things of that nature. Or let's put it this way, maybe you maxed out your 401k. Mm-hmm. You can put money in the health savings account. Now, you can only take that out if you use it for health items.
Right.
But last I checked, the older we get, the more we're going to be spending on health items. And it also relates to things like long-term care premiums.
That's right.
And expenses and things of that nature. So if you're maxing out your 401k, get with your financial advisor, talk about HSAs and how that may be a good opportunity for you. But the other thing that you would want to maybe spend excess funds on are your people.
Yes.
Your teammates. Do you need to grow? Do you need to increase your infrastructure? Is there equipment? Is there things of that nature that you need to put into place to grow your business? This all goes back to being intentional and being strategic and doing it at the right time. Mm-hmm. I always joke that we never want to be the firm. I never want to be the preparer who the client comes in and says, oh, I've got this unanticipated tax. First of all, that would be a problem.
Right.
But then we go, go buy an SUV. You're more money out of pocket. You may not even have needed it. Invest in things that have intentionality to it to grow your business. So that is the investing intentionally.
Well, I was going to say too, on the investment part, not a lot of people have the same philosophies when it goes to retire, like putting your cash into a 401k, and also being mindful that if your investment strategy is not in 401k, and i.e. buying real estate, and what are the ramifications of that, good and bad?
Yeah. And going to add on to that, putting more money back into your business may be your
investment.
Nest egg.
That's right.
And so it's the same concept of putting that money in to grow the business to get a return on investment when you exit. So get with your financial advisor, get with your financial coach. We've had a few of those on the show, so they can lead you in the right direction. Okay. Leveraging time and resources. Really, the concept here is just to be strategic and proactive and do things at the right time, whether that's the year-end planning. We want to be proactive versus reactive. Sometimes you want to defer income. Sometimes you want to accelerate expense. When are you making estimated tax payments? Is it right to make a pass-through election with the state to pay your state taxes for your entity? Do you have significant transactions in a certain year? Do you have sales or capital gains, or did you sell your business? Equipment purchases, all these things come into play when you're being proactive versus reactive. And I think the main thing that we always preach on this podcast is you have to be strategic, you have to be intentional, you have to be proactive. This empowers you as an entrepreneurial business owner. And you may still have to write a big check, but at least you put your head down on your pillow at night knowing that you did everything you can.
Yes.
And you were not surprised.
Don't throw everything into the box all year long and then open that box on March 30th. Absolutely not.
Absolutely not.
No, that is not a good use of your time or money at all. And so that's probably one of the things I hone in on when I do talk to a prospective client. Like, you need to think about it every day at 365 days of the year. Especially if you own your own business. You have to think about it all the time.
Over the weekend, I think we've joked about this before. There are times that I do go back and listen to our podcast, and not really to critique, but just really to listen. And I was listening this weekend to the one last week with Mikey Mangum.
Oh, yeah.
And he really dropped a significant piece of advice there. We just kind of glossed over it, but he mentioned that when he was growing up in the industry, he was talking to professionals outside of his industry, and he realized that the number one headache for business owners and entrepreneurs is the IRS. And so for him to do his job better, he needed to get with others in our industry to understand that situation.
Yes.
So if you find yourself in a position where you are feeling reactive and not feeling strategic, you're really not alone.
Right.
We run into that all the time.
That's right.
The key is to do something today to make it different going forward.
That's right.
The last I is integrate. This again goes back to being proactive. Sara, what would you say about this as far as why do our entrepreneurial business owners that are listeners need to integrate the right team?
Well, no matter how much we like to, maybe each one of us think differently about ourselves, but we're not perfect. And
we're not?
Right? And we don't know how to do everything. We can look up, yes, we can Google things, chat GPT things on how to do all the DIY, every part of your life. And it's not the best use of your time. I mean, back on the L, it's not the best use of your time and resources. So 100%, you need to, I think probably the biggest thing is to outsource everything.
I can't remember. Well, and if you go back.
And it was Sean Copeland, I think.
Sean Copeland.
And Keena Leva.
There was a bunch of them that have reiterated that piece of advice over our episodes.
Yes.
And I go back to a very good friend of mine who happens to be in this room with us, Clarence Fisher. We were talking about AI, and something he said to me that just really struck. He goes, you may have AI, and we were talking about from a marketing perspective.
Right.
I could just put my marketing plan, have it spit out a marketing plan for me. His comment was, you may have AI, but your AI is not my AI. And that's the way it is with us. We have AI that is specifically targeted to tax. And so I had that, I might have shared it before, but I had a call with a client and he said, well, ChatGPT says it's this. And I said, well, did you put in that it's this, your income level, it's capital gain income. He really just wanted to know what the rate was.
Yeah.
And when I told him it was a little bit more, he's like, well, it says this. I said, well, you didn't take these things into consideration. You didn't take into consideration the NIIT.
Right.
So that's a great place to start and get an idea, but it's not the end all be all. So have the right people on your team, outsource, feel comfortable.
And that goes not just business, but just in your personal life.
Oh,
right.
Mic drop.
Yes.
Well, that's the chili method. I'm going to write a book on that. And that way I can make lots of money off this acronym. And hopefully our listeners will remember it. But again, if we go back to it, it is choosing the right entity. It is harnessing deductions. It is investing intentionally, leveraging your time and resource, and integrate the most proactive strategic team that you possibly can put together. Right. And it's funny because we've just been practicing that every day for years and years and years. It's like second nature to us. And when we talk to new clients, prospective clients, they look like they're surprised,
right? Because
they never experienced that kind of thing. So if you have any questions about any of that kind of stuff, we are always open and welcoming to email communications. We would love to talk with you. But talk real quickly, Sara, before we go into our end process here about the do nots.
Oh, the do nots. See, I was getting ready for our next.
Material. This is bonus material.
Do not wait. So that goes back to your proactive comment. We don't want to be reactive and wait and kind of just be is it an ostrich in the same head?
Sticking your head in the sand.
Yes,
Yeah, that's what the ostrich
don't do that.
does.
And then you don't want to ignore any IRS or state notices. Open those boogers up. It's scarier on the outside than it is on the inside. And 9 times out of 10, I'm going to be honest with you, 9 times out of 10, it really is the IRS or the state agencies are wrong. And they don't have the correct information. And it's really steering the IRS to the correct things. So definitely open those boogers up and pass them on to your tax advisors. And then don't do it on your own. Again, it's okay to have help.
It's okay to have help.
It's okay to lock arms with a team.
I love your comment about the notices, because we get this all the time. We get notices sent to us by clients and they're freaking out.
Yeah.
And our response most of the time is, this isn't a big deal.
Yeah.
Let's just answer it. And we see these all the time. Don't worry about it now. And some of those notices use some pretty scary language.
Yes.
Like lien and
levy.
And it's there for a purpose.
Yep.
It's to get you to respond.
We're going to send you to collections.
Work with your provider to understand those. So do not let those just sit.
Right.
All right. With that, we're going to transition to rapid fire. But we're going to do it a little differently.
We're going to do it a little differently. We're going to kind of do it would you rather style this time, since it's just me and Frable.
But we got to give a shout out to our amazing partner, Caldwell. He's like, maybe you should do this.
Yeah. Or integrate those into rapid fire questions. So we are. We're going to test it out here. And also, just so you guys know, totally use some Copilot to get these questions. And I really haven't looked at them before. And I just plugged it in and set it aside before we got into this podcast. So I'm just going to pick. It gave me 5 different areas. So I'm just going to kind of pick one from each one.
Rando.
Yes.
Okay, let's go.
Okay. Would you rather always be 10 minutes late or 20 minutes early?
20 minutes early.
10 minutes late.
Okay. I like to be, so my family will tell you, like when we go to Disney World, until I get in my spot, I am just, so I need to be in my spot. It may be early. I don't care. That doesn't mean I'm always 20 minutes early, but that's what I would rather do.
See, I would not. I don't want the awkward standing around looking at people trying to make small conversation.
Well, no, you didn't mention that. If it's a networking event, I am going to be 10 minutes. I'm going to be 20 minutes late, so I don't have to do that kind of stuff. So,
yes.
Yeah, depends on the situation.
Yeah, I guess it does depend. But I do like being late because I like observing what's going on in this, and then I can kind of be in the background and just kind of look around.
Well, plus when you always walk into a room, I mean, it just
you're right.
lights up.
That's what my husband says. He's like, you just want everybody to look at you when you walk in. Right. No, I don't want anybody to look at me. But anyway, all right, let's see. Would you rather never have imposter syndrome again or never procrastinate again?
I'm going to start to cry on this one. I go to counseling for this stuff. I would rather not have the imposter syndrome again.
Okay.
I would rather procrastinate.
Really? Yeah.
I can deal with procrastination. I know I put myself in the wrong spot sometimes, but gosh, imposter syndrome sucks.
It does.
So, anyway,
it does.
What about you?
Probably, I'm going to go opposite on this too. Procrastinate, because I do procrastinate. I like a deadline, and I wish I didn't have to live by a deadline. I'm talking about in my personal life. Yeah,
I get that.
Yeah, because if I'm one of those scramblers before anybody comes over to my house, I have probably just freshly mopped before you walked through my door. Okay. Would you rather know exactly how your story ends or not know any of the twists ahead?
Oh, I don't
know if it means how your story ends. Maybe that's not a good question.
Okay, let's go to the next one. See, this is live as we speak. Yeah, we're not perfect.
Ooh, I really like this one. This is the next one. Would you rather be remembered for what you built or how you treated people?
How you treated people.
Same.
Yeah, that's pretty.
It. Yeah, that's easy.
I think if you work here.
Well, I think that if people remembered for how you treated people, it is the result of that is what you built.
Ooh, wow,
right?
That was deep. That was very, because I automatically went to a physical, tangible thing, and you went intangible.
Yeah, I
on
did.
Me, so,
I
yeah,
did.
That's a great question.
Yes.
And yeah, it'd definitely be the way you treat people.
Right? Yes. Okay, here's the spicy but safe.
Okay, spicy but
And
safe.
I'm going to do 2 questions out of this one.
All right.
Okay, would you rather be brutally honest or expertly diplomatic?
Oh, the diplomatic one. I can't be honest.
Well, I can't be brutally honest. Yes.
When it's a tough conversation, it's hard for me to.
Well, and I see, sometimes I would rather be expertly diplomatic because I think sometimes at least in my tone, it can come off
I just want to
rude.
skirt the truth because difficult conversations are hard for me. I'll admit it.
Okay. Would you rather take feedback publicly or praise privately?
Feedback publicly
or praise privately?
Privately. Probably the praise privately.
Yeah.
I don't have to have it in front of everybody. As long as I hear it. And my wife was laughing. She was hearing this. She'd laugh because it's something that you talked about imposter syndrome.
Yes.
We should have thrown in there the concept of pleasing everybody as well.
Yes.
But I just need to know that I pleased you.
Right.
That you were happy with me.
Right.
I don't need it in front of everybody.
Right.
So are we on the same page there?
Yes, I think, because I don't, well, I guess it depends on what kind of feedback it is.
If it's good feedback,
I want everybody to listen to that. I don't want to be.
Feedback is praise. That's what.
Yes. Okay. That's valid. So. Yeah. So I would rather be praised privately.
Yeah. Is that it?
Yep. That's it.
I could go on for days.
I know I could.
And these are fun. I think we just need to remind our listeners, the reason we do this is to give our listeners an insight into who we are as individuals and our guests. And so we hope you enjoy that. We'll probably sprinkle some of those in. Those were kind of fun. But with that, we're going to wrap up. As always, again, if you want to email us at podcast@cckcpa.com. That's podcast@cckcpa.com. If you have any questions, comments, insight, public feedback, I guess it'd be private feedback, but let us know. We love email and we want to hear from you. If you have any thoughts on if you got a really cool connection for someone you'd like to hear on this podcast, we would love to reach out to them. Just reach out to us, say hi, let us know. Thank you as always to CCK for just sponsoring us, for giving us the opportunity to use this platform in a different way. We always love to thank KP, even if she's not here, for protecting the brand and keeping us on the straight and narrow. To Robert Mays for our music, our intro and outgo. Do you want to finish this up? Clarence Fisher, Tulsa Internet Marketing Services, you are the bomb. And some of our wonderful administrative teammates, Emily Johansson and Dasha Ferguson, thank you so much for helping us get this on the air and across the finish line. We hope that you enjoyed today's episode, that you learned some things and learned some areas that you should be asking more about. And as always, join us next time as these two CPAs get together to have a chat and you get to find out who's on the mic.
The information provided on this podcast is for general, informational, and educational purposes only and does not constitute accounting, tax, legal, or financial advice. While we strive to provide accurate and up-to-date information, laws and regulations change and individual circumstances vary. Always consult with a qualified CPA or professional advisor before making any financial or business decisions. The views expressed by the hosts and guests are their own and do not necessarily reflect the opinions of any organizations they are affiliated with. Listening to this podcast does not create a client-accountant relationship. By listening to this podcast, you acknowledge and agree to those terms. And that's a wrap for this episode of 2 CPAs and the Mic. If you found today's episode helpful, please subscribe, share, and leave us a review. Have questions or ideas for a topic? Reach out. We'd love to hear from you. Email us at podcast@cckcpa.com.